What if I told you every single tool you've ever used to analyze a chart, every candlesticks, every trend line, every support, every moving average, every resistance, or whatever it is you call it, exists just for one reason? And that is to answer the question, where is the market going? Most traders lose money to trading not because they can't read or interpret charts. Many traders lose money because they can't identify what a trend is or even where the trend is going. They think up and down is all there is to trading, and that is not true. By the end of this video, you would understand trend on a level that most retail traders don't. And I'm talking about a framework that most professional traders, analysts, and institutional traders you ever get to know or seen or aspire to be like have relied on for over a century, trading for years and decades. So now, let's get right into it. If this is your first time on this channel, welcome. And I want you to know that you are the very right place where you need to be if your goal is to have proper and real trading knowledge that can take you from where you are to becoming a very good professional. Not just a professional that have good trades, but a professional that understands why, how, and what makes the market move the way it does. If you're enjoying this value so far, please leave a like. It genuinely helps this channel to grow faster and better. And please stick around, because before the end of this video, I'm going to be sharing with you a trading tip that took me years of trading, trial and error to experience. So let's start with the foundation. In its simplest sense, a trend is just the direction the market is moving to. But that is a very lame definition for us to use in this context of defining a trend and understanding what a trend is. So let us work on a proper, well-developed definition of a trend that will make you understand and have the feeling of the true purpose of a trend, or what it is, or what a trend means to a trader. We need something more precise. So this is the first thing you need to unlearn. Markets do not move in a straight line. Never ever has the market moved in a straight line. Every price action you see in the market is a series of zigzags, wave of ups and downs, revealing peaks and troughs in the market condition. Or as you might know it, we are talking about highs and lows. And you see, it is the relationship between the highs and the lows, the peaks and the troughs, not the high and the low themselves, but the relationship between them that defines what a trend actually is. And that leads me to talk about the direction of a trend. You see, here is where most traders get it wrong. Many people believe or are of the opinion that the market moves or trends either just higher or lower. But in reality, the market moves in three types of trend. That is the uptrend, the downtrend, and the sideways trend. Against contrary belief as well, the market spends most of its time in a ranging market or in the sideways trend. So the market is not always just going high and low. Most times it goes high, takes a little rest, either go up from there or come down before it goes low. So what I mean by that is you would often get to experience a consolidating market or a sideways trend more than you get to experience, or much as you experience, an uptrend and downtrend. So let's define all of these types of trend one after the other. What is an uptrend? An uptrend is a series of successfully higher peaks and high troughs. Like it is being displayed on the screen, you would see the peaks and the troughs. They are actually going higher than the previous one. So this is considered mostly, or what you hear people name it or label it as, higher highs and higher lows. And that leads us to talk about what a downward trend or a downtrend might be. So a downtrend in this sense is the exact opposite of what an uptrend is. That is, a downtrend is a declining highs and declining lows. So in that case, you have lower highs and lower low, because the new high that is going to be marked is going to be lower than the previous high, and the low that you are going to mark is going to be much lower than the previous lows. So we've talked about an uptrend, we've talked about a downtrend. Now let's talk about the very interesting one, which is the sideways trend. A sideways trend, also known as either a consolidating market or a ranging market, is the type of market condition where which the highs and the lows, the peaks and the throws move horizontally, almost at roughly the same level. The sideways trend isn't just accidental. It reflects something the market is trying to say to you. It is reflecting the equilibrium in the forces of the market. That is, it is showing the tug of war that is happening between the selling pressure and the buying pressure of the market coming together, and because these pressure are almost the same thing, it creates a kind of balanced momentum. So the market is not going higher than it was before, and it's not going lower than it is, which leads or causes the market to oscillate in just a certain range instead of committing to a particular direction. If you are a student of this channel or you've watched our previous videos, you will get to understand that when we talked about Dow theory, in which you can find in the video above that is popping up right here, you will remember that we mentioned this and explained this carefully as a ranging market, and some people also like to refer to it as a trendless market, but I say it is not trendless. It also has its own trend and has a way of you getting to bring out the best in that particular market. If you don't understand what I'm saying, you don't have to be scared, because you can just check out this video, then come back to this one, you have a full understanding, because we broke it down there already for you. Now here's the tip that I promised you. You see, almost every technical tool that you own, your oscillators, your moving average, your trend lines, whatever you might call it, are all created to serve just one purpose. And they are also created on the assumption that the market is moving in a trend. You see, sometimes they might even fail you completely. They give you wrong signals, they whipsaw your trades in and out, and gradually, bit by bit, drain out your account for you. Then you start feeling like, oh, maybe you are doing the wrong thing or you don't know how to trade. No, it is not that you don't know how to think. You are just applying the wrong or the right tool to the wrong market. Because the first thing you have to realize is define the type of market you are. These tools you are using are created on the core assumption that the market is moving in a trend. So the problem is not with the tool. The problem is with you. You're trying to apply a trend following tool for when the market is actually just moving in a range. A trend following tool is designed to work when the market is in a trend or follow a trend. So if you're applying a trend following tool to a consolidating market, the problem is not the systematic application of the tool. The problem is you using the right tool for the wrong time. They will definitely fail you. Now that we've understood the direction or the concept of the direction of a trend, let's take this a bit lower. Let's dive deeper by just one step. You see, the thing here is the market just don't go, or the trend just don't go in a direction. No. A trend has both direction and size. This size can also be referred to as duration. So it has a direction and also has a number of time that it uses in that particular direction before that direction expires and it goes to the next direction. In reality, there isn't just one trend playing at the market at one moment. The truth here is there are a series of trends happening in the market and moving into one another. As one is expiring, another one is taking place and taking form. From short-term moves that last hours, couple of weeks, couple of days, to long-term moves that goes down into 6 months, years, 50 years, or even a century. Right? So Dow, according to Dow theory, Charles Dow was of the opinion that a long term is a kind of, a market move that lasts, years. But considering the fact that most futures traders or most futures trades don't have a very long time span, so I would say that a long-term trend is a trend that lasts above 6 months. And to keep things simple and practical, we are going to use the three-tier description of trends we use in the Dow theory, which is the major trend, the intermediate trend, and the near-end trend. Classical Dow theory defines a long trend as anything that is lasting beyond a year. However, this is a very good principle that is worthy of note. But at the same time, I like to align with the thoughts of J.J. Murphy, considering the fact that most future trades, or let's say future trades, futures, don't last long. So I would like to align with the thought that long-term trends are trends that last 6 months or above, maximum 6 months above. Using that same framework, we would define intermediate trend as any trend that lasts in the market starting from 3 weeks to several months, and the near-term trend as any trend that lasts below 3 weeks. What I'm trying to say to you is, like we've said earlier, the market has three trends, right? You remember we defined that earlier, that the market has three trends, which is the uptrend, the downtrend, or the sideways trend. So if, for an example, an uptrend gets to last beyond 6 months, that is on a wider time frame, maybe in the monthly time frame, in a daily or weekly time frame, that is considered a very long-term trend. And if a trend gets to just exist between 3 weeks to several months, let's say a downward trend, a sideward trend, that is going to be considered an intermediate trend. And if a trend doesn't get to last beyond just a few weeks, we'll consider that a near-term trend. I believe you got that right. You can comment yes if you got that, so I'll be able to understand you're following. So this is what you really need to hold on to when it comes to the size and duration of a trend. Each trend is just a piece of the next larger trend to occur. For an example, an intermediate trend is most likely a reversal in a very long-term uptrend. I'm displaying an example of this right here for you on the screen. You would see that the market has been moving in a very long trend for a particular period of time, and shortly after that, it had a correction. You would see that correction there, that pause in the market taking a break, because the market is not just a computer that runs like that. It is a series of emotions coming together to be interpreted with candlesticks. So people have been buying and buying and buying. There has to be a break. That break of purchase is what we call an intermediate trend, because the market is going to either reverse or just operate in a sideward trend, and that might lead to some patterns you are familiar with, like the triangle pattern, the flag. You understand? So that is the break, that is the rest. Imagine you climbing a mountain. When you get to a particular peak, you want to take your rest. So that rest there is what we call the intermediate trend, because it will last for a couple of weeks, but the market will resume to its previous or the bigger picture of its direction. This is where law of argument from different traders come from, because two people can be looking at the same market and having different interpretation, not because they are both wrong or they are not right. The fact is just the fact that it is a matter of perception. So what you might understand as a long-term trend might be what somebody will relate to as a short-term trend. For an example, someone who trades stocks, options, or commodity would see something below 6 months as a short-term trend. However, someone who trades futures trade would consider something close to 6 months as a long-term trend. So most times when you see people argue, you're trying to relate or depict or interpret what you see in the market to somebody and they don't get to agree with you, the first question you should ask yourself or ask the person is, what do you identify or define as a trend, either an intermediate trend, a long trend, or a near-term trend? Because to a long-term trader, a trend of just a couple of days, couple of weeks might be completely insignificant to him or her. You might just even consider that just like a noise in the bigger picture of the major trend. However, this same trend that is considered a noise to a futures trader, a day couple of hours or consecutive days of a particular trend repeating itself is considered a long trend. So most times when you're trying to explain your idea, the vision or the interpretation of the charts you see to somebody and they don't get to agree with you very well, the first question you should ask yourself or this particular person is, what do you consider a long-term trend? Or how do you define your intermediate trend? Because market itself or market analysis or interpretation itself is just a matter of perception. So now let's bring everything we've discussed so far together. Number one is that we establish that a trend has three directions, namely, you got it right, an uptrend, yes, a downward trend, and a sideways trend. That's very good. Also, we defined that a trend exists on different time frame, coexisting in each other. That is, we can have the long-term trend, right, the intermediate trend, and the near-end trend. So, and these trends are not just defined by their direction, they're also defined by their size or their period. Some last for a week, some last for weeks, some last for months, couple of months, 6 months, or even a year, and why some last just for hours. And the sizes are what is going to help you identify what type of trend is happening in the market. The smallest is the near end, the next is the intermediate, and the biggest trend consistently occurring in the market is referred to as a long-term trend. Identifying this concept is the foundation in which or on which everything about technical analysis is built on. But you also have to understand that identifying or understanding this concept is not enough for you, because it is just a step in many steps you need to take to become a professional trader you want to be. So the real idea is not to identify the trend. The real question you should ask is, how do you trade it? How do you trade the trend? And that is the question we are going to be answering in our next video. We are going to be talking about support, resistance, supply and demand, and also trend lines. So if this video gave you clarity so far, hit the like button, subscribe so you will get to have the notification when the next one comes in. And if you've learned something, I would love to hear from you what you've learned so far in this video. You can just type it in the comment section. I'll be so willing to hear from you. Don't forget to share these videos with your friends, your co-traders that you believe would learn something also from this video. I'll see you in the next video. Till when next I come your way, stay cool and play big.